All right, here we go. Wednesday, June 3rd, and so moving into the mid-year month here. Hope everybody's been doing well, making money, uh, being successful. Time to kind of look back at other parts of the industry. I think I haven't checked in on the old landlords lately and what's been going on there. And been hearing some rumblings here in Florida. I don't know what's going on in Carolina, but we'll find out. I'm joined as always by Dwayne Gibbs. Dwayne, what's happening?
Hey, good morning.
What are you hearing as far as landlords and foreclosures and activity like that, pre-foreclosures up in Carolina?
Um, I hear that I have a buddy of mine that has about 400 and some doors, and he's in a group out of Charlotte, and he's telling me that people are just, he's wanting so much to get out of the business because it's just so much headache.
Yeah,
And um, with people not paying and then with construction, I don't understand, but construction around here is going like crazy. They're
yeah,
building, 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 building so much. And um, I don't know how people can afford not only with bank rates, but um, the cost of what everything is and where they're coming up with this money. I have no idea. Foreclosures, you don't see many foreclosures going on up here,
yeah,
but people are definitely wanting to get out of the landlording because it is so chaotic. People are making payments, not making payments. It's just a ton of work that at the end of the day, it's not worth it for them.
yeah, yeah,
My buddy with these properties that he has even talked about really wanting to sell a bunch of these units off, even though he doesn't want to. But, we've been talking about the note business for years. And he's just like, I think I'm coming to the point where I just need to convert these over to a note. And, he's like, I just hate to have that. And I said, well, let me break it down why note investing can give you the same thing as renting these properties out for a long period of time. You're
mhm,
dealing with so many headaches and people not paying. Well, let's look at it this way in the note business. If they stop paying, how you're protected and, creating a good viable note could then be a possibility to you put them on a secondary market and making money that way. So I showed him multiple ways of how to convert a lot of these into, and I'll be honest with you, I think he's possibly wanting to go this route. We've talked about it, like I said, for years. He's been a
yeah,
friend of mine for 12 years, always, dabbled in wanting to go that route, but now I think it's becoming so chaotic for him that he don't want to do that.
yeah, yeah. I've got friends in real estate here in Central Florida, and I've got a guy, same thing. He's very interested in notes, has been for a couple of years,
Yeah.
but you get stuck in these patterns, I guess. And he's been
It's
good
just
with
something
his
new.
yeah, with his real estate sales is what he does. But he sent me an email just saying, "Hey, I'm seeing some more activity in the pre-foreclosure market. It's making me think about non-performing notes again, that sort of thing. I want to get together with you." Um, so he's looking at that from that angle. But on the other hand, my other friend in real estate, they're still selling house, same thing. They're still selling houses like crazy, and
Crazy.
it's
New
like this
construction around here is
yeah,
ridiculous.
yeah, yeah. So the building around here is slowed a bit, but still still active and such. So I did some research on this because it is one of these things that we run into quite a bit. People looking at rental property versus notes, and I get it. Part of it just is familiarity. Everybody has either rented or they've been a landlord. So they get that concept. The whole concept of notes, well, wait a minute, you don't own the property, but you have the debt. How does that work? That's a little foreign to people because they haven't done that. But again, everybody's been a tenant at some point in time or they've been a landlord. So it's a simple concept to understand. And I think that's why a lot of people gravitate to that and get involved in that. It's just easy to understand. But man, notes is not that much more difficult to everybody. And I'm going to try to lay out for you a little case here because I just, think especially today, and I'm going to use, real numbers, from today and what's going on in the marketplace. And again, keep in mind, I know this is going out on Facebook and other channels and social media and my YouTube channel and I repost on X, and there's people all over the country. So yes, real estate is local. Totally get it. So we go on national stats, and then you can tweak your numbers accordingly as you wish on this. But I think the overall argument is simply, let's compare. Let's see where you might want to be for the rest of 2026 here. So in 2026, real estate market snapshot nationwide, mortgage rates have stabilized a bit at 6.3 to 6.7. Now, big picture, that's not horrible, but most people are still thinking about recent history when they were 2%. We're not going to see 2% again for a long time, everybody. So, you're if you're waiting on the sidelines to watch that drop and get down to 2%,
It's not
see in
going
a
to happen.
decade. I mean, it's just not realistic. We had interest rates in the late 70s, early 80s at 18%. So in the big picture of things, 6% is not horrible, but it absolutely affects your mortgage payment. I mean, you compare 2% to 6%. I get it. But there's a lot of people who also go, yeah, but property values are going up. Well, that's also stabilized. So now we're starting to see the market calm down a bit. The appreciation rates are not going as fast as they have been. And again, that's a good thing. If you already own a home, you're probably hoping they would continue to go go up, I guess, at some point. But that's not a bad thing for the industry to cool off a little bit because it was, I think, like you said, Dwight, I think prices are too high right now. Around here where I live, I'm like, I'm like,
Property taxes are through the freaking
there's,
roof. It's
oh
ridiculous.
yeah, there's no way, there's no way. So inventory is up, so there are some people who are finally starting to sell. So that does create more opportunities, to buy real estate, that sort of thing. So, you know, um, it's not a bad time to look at buying real estate for rental property because the market started to mellow here a little bit. Okay, one could make that argument. But let's talk about who's really making the money on this. Okay, so if we break it down and look at cash on cash return, typical landlords are making about 7%, okay, nationwide. A strong landlord is making about 10%, okay? And the ones making 10% either have a really good market or then really high-end properties. And some of you might think, well, I could shoot for the 10%. Well, what kind of landlording are you going to be doing, and what neighborhoods and what price range can you afford? But 7% is typical. Typical note investors making a minimum of 10%. What a strong landlord is getting. So 7 to 10% is kind of the range of cash on cash return for landlording, where 10 to 12% is a typical cash on cash return for note investing. Okay, so number one, as far as returns, we get it. Now, one will make the argument, but if you own the property, it appreciates, you also got it. And you're totally right. But again, appreciations are starting to slow down. They're at 1 to 2% per year. Okay, so this is just one picture of what we're looking at on the return. I get that. Um, the killer, and you alluded to this, Dwayne, and I didn't prompt him to say any of that. It was right off the cuff, everybody. So, but it is true. I mean, if you've ever been a landlord, the crusher is just those repairs that just come up. It can wipe out 3, 4 months of your positive cash flow.
See, what people need to realize is the more units they have, that rate goes down. So you're talking about a high end. Obviously, if you only have one or two properties, your percentage will go up a little bit more. But, if you're looking at 50, 60, 80, some people have 200 units, that percentage goes down.
Mm-hmm. Mm-hmm. Yeah, your overall returns and you've always got the repair issue that never goes away, but the cost has gone up.
Of course.
And that's what really catches a lot of these landlords that are really just getting by, right? Because I went and looked at cap rates, and I know cap rates can be confusing to everybody. It's not the same as cash on cash return, but cap rates are even lower. Cap rates right now. So for again, if I go back to this example here, cap rate for a typical landlord is 4 to 5%. The cash on cash return is higher. Um, but it's because of the calculations. The cap rates don't consider debt service. They just go, oh, if you own this free and clear, here's what your return would be. Well, most people don't own these things, free and clear. So the repairs and maintenance then, that's often 25% or more of your expenses. And you mentioned insurance, and that was another thing that these stats came up with. Property insurance premiums are up sharply in a lot of marketplaces. Geez, here in Florida, our condo market was decimated. I mean, they have when the building fell in Miami, that changed everything uh, because now there were repairs that had to be made, there were inspections that had, and rightfully so. I mean, lives are at stake. They had to go through this, and they're inspecting every condo over a certain number of units. Insurance premiums have gone up as a result of that. Property taxes have gone up. We'll see what happens in Florida. We just had a law pass about our property taxes, which is rather interesting. Doesn't apply to landlords, though, everybody. So when you see that whole thing in Florida where they're talking about, oh, you don't have to pay property taxes. Nope, that's homestead only, has nothing to do with landlords at all. Landlords will continue to pay property taxes. And if other people aren't paying, I wouldn't be surprised if that goes up a little bit there. So insurance premiums up, all that sort of stuff is up. And here's the breakdown for 2026 on national averages. So of your operating expenses that you're looking at, repairs and maintenance 25%. That's the biggest chunk. Prices have gone up. It's that time of year, summer, and you got air conditionings and all kinds of stuff that starts to happen when the weather's starting to change here. You got management expenses around 20%, 15% utilities, 20% property taxes, 20% insurance. So yes, insurance and property taxes alone, 40% of your operating expenses. Uh, Add in the repairs there. And yeah, your returns are not going to be the same. So expect those cash on cash returns to typically fall in 2026 as expenses start to go up because they're not maintaining. You combine that with the fact that property values are not appreciating like they were. It really comes down to, well, what is that positive monthly cash flow that you're getting? And you can't just compare. Like I said, you can't just say, oh, well, cap rates for real estate, for landlording are 8%. It's like, yeah, you're not considering debt service, right? That's a whole different equation here. So a typical $300,000 rental, and again, you talk about property values, right? I think that's pretty good for most people. A $300,000 rental, gross rent $24,000 a year. Net cash flow drops about 20 to 30% to your point there, Dwayne, and the effective cash on cash return falls from 8 to 5 to 6%. And most people buying a $30,000 rental have put $60,000 down and they're carrying a $240,000 mortgage that they're responsible for every month, taking on that debt. And then if the tenants don't pay, you're still out the pocket. I don't know. You compare that to note investing. Note investing, 8 to 12% continued consistent yields. Now, why are our payments more consistent than a rent, than a tenant? I have people sometimes make that argument to me. It's like, well, it's the same thing. You don't know if a borrower is going to pay versus you don't know if a tenant's going to pay. Like, well, the tenant is a temporary person there.
Right.
It's they don't go to the schools in the area typically, right? They don't, it's depending on the tenants, obviously, but I mean, it's just they don't have a vision of they own it. So number one, they don't take care of the property like they own it for the most part. You are going to have tenants that are more fluid. They move in the middle of the night, they leave. They know that the laws are written in their favor. They know if they don't pay this month, they're not out of there on the streets next month. Doesn't happen like that. Um, you know, it's they don't have that equity in there. The notes that I show you, if you go back and look at some of these Wednesdays or go back and look at my YouTube channel, and just look at some of the case studies. There's people who we buy notes that's $100,000 house. They owe 30,000 bucks. Their monthly payment is half of what the rent is in the area, but it's all their equity. They've got $70,000, $80,000 in equity that they don't want to lose. You can't compare that to a tenant. A tenant has zero equity in the property, zero care about what happens to that property, and quite frankly, if they don't pay you, they know that they've got some time. What are you gonna do? You know, so you just compare it from that end of it, everybody, where you're getting consistency. They're motivated. Borrowers are motivated to stay and pay under the right circumstances. And all these case studies I show you, they are motivated to stay and pay. Their payments are affordable. Their house has gone up in value. They've got equity at risk if they don't pay. They're invested in that property. They've been there for 10 years, 15 years. They're not a tenant who's been there for 3 months. It's more consistent, everybody. It's just more, it just is. Okay. You own the debt, not the drama. I like that one. So, to Dwayne's point earlier, where his buddy is thinking, I can convert some of these tenants into property owners where I'm getting monthly cash flow, like I have been through the rent, but without all the drama, without the toilets and the tenants and the repairs and all that budget that you have to allocate every month. Because if you're not putting away, and by the way, most landlords don't take every month and put away 5 to 10% of what they're making for that upcoming repair. Even though they know the repair is coming, they know it's going to happen, they don't put it away. And then it happens, and now they're like, oh my God, now they got to come out of pocket for paying whatever repairs. Repairs are more expensive. Again, really think about that if you're considering getting into being a landlord or getting into the note business. Really think about these issues, everybody. If you're a landlord already, there's a better way. I'm not saying sell every property that you have. Some of them might be great, others not so great. You can convert tenants into property owners, right? Or you can now diverse your portfolio and get into notes and try it while you have your rental properties. It just makes sense and see which one you ultimately like based upon performance. Right?
I talked to him about looking at people that have been in a unit that are paying consistently that are good tenants. And I said, maybe reach out to some of these tenants that, because they have such a good pay history and they've been taking care of the property, why don't you look into seeing if they would like to own these properties? Because, at the end of the day, um, obviously you can't do that with an apartment complex, but
Right.
You could do that with a duplex or a quad or, a single family house.
Hmm.
And people that may have some interest. And he said, that's a good idea. So he reached out to some of these people. He sent them a letter. Hey, let's chat. I want to chat with you about something. And I said, break it down and showing how much they paid as a tenant versus, really not owning it. Obviously, you don't own anything, but hey, if you own this property, now look at what you have. And so, he understands that. And so he approached some of his tenants, and some of them show great interest that they want to buy. So not only did he make all that money from as a landlord, now being able to get a downstroke of a down payment, and now being able to be the bank on these notes. I mean, it's a win-win for him.
Oh, plus think about capital gains.
Oh, absolutely.
He won't have to pay capital. He can sell his house without paying capital gains. He'll just
Yep.
pay income taxes on the income that he's getting on the note.
Yep.
So he'll pay that in installments, if you will, versus a lump sum, and that's a great way. It's a great way to go. And you're right. And the tenants, I think, when they look at that and go, well, gee, we have been long-term tenants, and it does make sense for us to stay here, and it does make sense for us to participate now in an equity position. You mean we don't have to go to a bank? We don't have to supply all that paperwork. We don't have to, declare all of this, that, and the other. No,
Yep.
you know. Yeah, it's
And I
very
explained to him, you don't have to sell it on a secondary market because he likes that generational
sure.
income. And I
Yeah,
said, hold on to it. You don't
yeah,
have to sell it.
yeah.
If that's what
Keep
you
it.
like to do. I think a lot of people have the preconceived notion as well. If I do that, then I'm not going to have long-term income. What do you mean? You're just holding that paper for,
Hmm.
banks do it every single day. They'll hold it for a long time.
Yeah,
Um, and don't sell that note off. The reason they sell the note off is because they need that money to go out and buy more assets.
yeah. And when you're structuring a note like that, the advantage you have there is that the tenant's been able to afford a certain payment for 3 years, four
He's
years.
already proven his track record.
Let's structure the loan so that your payments are about the same.
That's right.
And a lot of times that means a shorter loan and higher monthly payments than if you were doing a new loan to an unproven borrower.
Hmm.
Which is kind of interesting. So you might end up doing a 20-year note or a 10-year note instead of a 30-year,
Hmm.
and the people can
Yeah.
afford it because they've proven
Yeah,
that.
sure.
Yeah, 100%. Yeah. And then all of a sudden, your note is protected by the collateral. That's another thing. If you're a landlord, what's your lease protected by?
Nothing.
Nothing really. I mean, sure, you have legal recourse, but good Lord, get on Judge Judy every once in a while. Every other case is like, if it's not I got so and so on my T-Mobile account. It's landlord tenant, right? I mean, those are God. If it wasn't for cell phones and rental
One for
property,
Judge Judy.
it's just like that. Every case is fighting over. I got my security deposit back. No, here's proof that well, I don't know. It's like, oh God, and you know, so your lease, yeah, it's protected by the law, but then you got to go to court. You got to try to collect from people who have left. It's just like, come on. With our note, we always have that property. As a landlord, you've got the legal system protecting you, but once again, most of these laws, it's unfortunate, especially in a lot of states, it looks like the laws are written more in favor of the tenants versus the landlord. Watch what's going to happen in New York, everybody. Watch what's already happened in California. Where landlords are just throwing up their arms like, why am I even doing this? The law fights me every time. I can't kick these people out of the house. You try that stuff in Florida, you're out. So a little bit different. So where you live and where you invest here, but the point being, you still have, as a landlord, you still get that debt service. You got to pay the bank every month, right? Whether that tenant's paying or not. And the bank is the one who's going, if you don't pay us, we'll take that rental property back and resell it. We'll foreclose on it. If we are the bank, Our note is backed by legal action that could foreclose upon a house. Okay. Is that a legal process? It is a legal process. Okay. So is there court involved? Depends on the type of note that it is, but okay, there could be court involved in that. But the action is conclusive. Unlike getting a judgment like a landlord and trying to collect on a judgment. No, no, no. We have a foreclosure schedule, and that house will go to sale
See,
if worst case scenario happens.
and another beauty about it is if your tenant doesn't pay, just like you were saying, and the bank wants to foreclose on you. But listen, things happen. Maybe
Mhm.
the guy lost his job or or he's going into a new job and he just can't pay for 3, 4 months. You, as the note owner, can adjust it. Oh, okay. I see what's happening. No worries. We'll just take that monies, put it in the arrears, and we'll make it back up. You don't have that beauty if the bank calls the note due or they want to foreclose on you. Well, this tenant's just going through this, and no, 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 no. You don't. There's no way that you can adjust that for that payment. I mean, if the bank decides, hey, they're going to come take it, versus if you own that note,
Yeah.
there is structured ways, of being able to understand the terms of what they're dealing with and deal with it then.
Yeah, it's interesting you bring that up. I had an email yesterday with Carol, a client of mine, and one of the notes that we did a joint venture on. Um, the guy made 8 payments last year. So far, he's made January through April this year. Haven't seen a May payment yet. Um, Okay. His principal balance is not going down that much. When
That's
we
right.
bought that note, we knew that this guy doesn't make 12 payments a year. We knew that, but the price that we paid for that note was adjusted accordingly. So for us, it's like, all right, well, we'll see what happens here in June if he makes a payment to try to catch up for May. But we're not losing anything because, again, that principal balance is just being added to and penalties and interest and all that sort of stuff as well. Yeah,
But if it wasn't
100%.
conventional financing, you don't have that flexibility, is
Yeah,
what I'm saying. Yeah.
yeah, yeah. So it's mailbox money, it's the old, but it's today it's ACH money, right? Just goes into your bank account, every month without all the headaches there. So, I'm trying to make like not really a debating on these. I'm trying to really just compare these two things together openly and honestly, and that's why I always go to national data, where I'm not trying to pick specific markets and just pick specific examples. I mean, let's look at the overall tendency. If you're making a decision, which way am I going, or which one's best for me and my family in the future, it makes sense to lay these things out and just compare. And I think it's hard to argue in 2026 that landlording is a better way to go. Now, where you live, maybe that's the case, and that's for you to judge. But everybody else, take a look at that, because I think if you did a summary, which I did for you here, you're looking at these low cap rates, cash on cash returns, 6 to 8%. But again, when you add in that year of repairs, that you're going to have, maybe you went repair free for 2 years. Well, great, but it's coming, right? It's coming for you. So you're going to have a down cash on cash for a year where more consistency on the note investor side. We're looking at, oops, I did an error on that. There we go, 10 to 12% on the note side. Okay. 10 to 12 is where most things are happening there. And again, you're looking at maybe 8 to 10 cash on cash return if you're on the high end side to be consistent. And repairs and maintenance, we don't have any. We don't own the home. How cool is that? You're making cash flow. You don't own the home. Okay. That's why banks have the tallest buildings in every city in the US, except for Vegas, where they call them casinos, right? But why? Because they don't own the debt. They don't have the repairs and the maintenance. They just have the debt service coming in every month. No ownership, no liability. You take care of that. We'll just provide the funds for you. Just make us the payment every month. And if you don't, then, well, we'll see what happens with the property. Okay. So we don't have that budget of putting that aside, 25% plus for expenses and I'm sorry, for repairs and maintenance. Time per property. Yeah, ours is a one time usually, as a note investor, the one time just looking at and evaluating if we're buying that note. After that, unless the note is a slow payer or something like that, you're really not paying that much attention. You're making sure that insurance and taxes are paid every year. Your servicing companies typically do that, but you could check that, so an hour a month it's less than that. It's really in some months there's nothing. There might be a whole 8 months. There's notes I've had for with partners over the last 12. Well, let's see. Some of them are probably approaching 15, 16 months. Never looked at again. Never put. I might look at the scan down my portal on the servicing companies and just see if anybody's late, and that's it. Boom. So it's really, really, really hands off. Where I don't care if you don't have a property manager, well, you do, right? You are. But if you hire a property manager, there goes part of your money. But you hear people who own real estate all the time feel like they're still the property manager. They may not be there for the day to day, but something else comes up, the property manager has to contact you and say, hey, this expense is going to be over $1,000. So we had to reach out to you because you might have told your property manager, don't bother me with stuff for less than $1,000 or $500. Great. If it goes above that, guess what? We need your approval. We got to get this and that done. So and so isn't paying. How do you want us to handle it? He's been 3 months behind. So there's still a lot of effort that you need to do as a landlord. I tried it, didn't like it from the very beginning, and I'm kind of glad. I didn't have a great experience as a landlord, so for me, it was a short-lived part of the thing in my real estate career, and I'm kind of thankful for that. Wasn't at the time, was pretty unhappy with tenant situation, back then, but you know, I prefer the low stress level stuff, bottom line. And that's what you have as a note investor. With traditional landlord, you've got the pressure of the debt service over here, you've got the tenant, over here, the activity involved, the management. It's going to be higher stress. You're getting pulled from both sides, and with the note investing, again, they're motivated to stay and pay. They have an interest in staying and paying to establish more equity. They don't want to lose their home, et cetera, et cetera. They don't want to lose their equity in the property. So you're not being pushed and pulled at the same time. And scalability, um, at some point in time, if you're buying single family homes and renting them, you're going to be limited because you won't be able to borrow money, at least from a bank, and then you go private lender, and then you're paying higher interest rates, and that's cutting even more in your margin. So you really got to think about it because you might outprice yourself at some point in time. As a note investor, you can scale it. You will be limited to your own capital. Okay. So that's where you can do things like sell partials. That's where you can do things such as hypothecation, borrow against the note, that sort of thing. Speaking of which, my new course is going to be coming out on hypothecation. So I'll be advertising that pretty soon. And that'll be something, if you're in the note business, you absolutely 100% will want to get. If you're not in the note business, it's something that you absolutely should get and learn about, because if you learn about that and what you can do for scalability as a note investor, you would definitely get involved in the note investing things. So 2026, I gotta say, notes is the better way to go between the two. You guys can research it on your own, but I think you'll come to the same exact conclusion that I did, that just in the real estate environment, especially right now, look at, instead of buying a rental property, why don't you look at a note, and start doing it that way. I think you'll find it a lot stronger play. Thoughts, Dwayne? Comments?
No, I think it was a good session. I think definitely is something that more people are being aware of. I think that um, there's definitely a play here. And for those that are on the fence of, hey, I, this makes sense to me, it makes logical sense, and I'm getting to a point to where I really don't know what to do. I'm having some problem tenants, and I'm just really wanting to throw my hat in the ring of learning more about the note business, schedule a call. Go to
Yeah.
kevinshortell.com, schedule a call. I'll be glad to get on the phone with you. We can talk about the deals that you have. We can give you an idea of what that looks like, and just give you a clear understanding of the note business if you're not doing it now. Those
Yeah.
of you that are doing it, hey, what does this look like? Because we have a network, Kevin has a network of people. We have people that want to buy notes. We want to buy notes. And so we have the ability to do it. And so there's a lot of, besides our training, there's a lot of things that we can help you with. So just schedule a call.
I agree. I concur. All right, everybody, you know what to do. And if you want to see again a replay of any of these, if you've missed a couple of Wednesdays, you want to see my tip of the day, go to YouTube. I've got a YouTube channel. Just search my name, Kevin Shortell, Shortle. Follow me on social media on X and LinkedIn. And until next Wednesday, have a great weekend, and we'll talk to you again soon.